We have assembled an all-star Fox panel to talk about this wild day for the markets.
Our own Liz McDonald, independent trader Eric Bolling, Victoria Barrett from Forbes, Gary Kaltbaum of GaryK.com, and Peter Schiff, author of Crash Proof. I want to go to Eric Bolling first because he's a guy who spends a lot of his time in the pits. Tell us what those pits are like right now with all this craziness.
Well, interestingly, one of my big notes here is what happened today? What happened today? Why is this different from 1987? The difference here is that electronic trading is so prevalent. What's going on is you're seeing these index funds, the S&P futures and NASDAQ futures and the Russell futures push markets down overseas through the night. I'm watching this thing all night. You know, at one point we're almost 600 Dow points lower early this morning. And that's because the S&P futures were limit down. They were locked limits 70 points down. What's happened? You have a lot of young traders. You have a lot of young hedge fund managers saying, I got this huge portfolio. How do I hedge this? I got to hedge my downside. They've never seen this before. They weren't around for 2000. They definitely weren't around for 87. So they're just selling index futures. So then you get this huge volatility in the index futures, and it's the tail wagging the dog, David. The index futures are actually pushing the Dow stocks around through that index future mechanism. I'll tell you, very, very treacherous, volatile, scary markets. I've traded both 87 and 2000. I've never seen anything like this. If you don't have to trade, step back, take a breath, and take a look at this later.
Gary Kaltbaum, you predicted last week a little early, but then you restated it yesterday that we would absolutely see a Fed fund rate cut before the market opened today. You were right, but the market didn't seem to embrace it that much. What did you think?
And I also had the Giants against the Packers, too, so that's real important.
Perspective.
Look, you know, the big thing that you need to know is the Fed's just been so way behind. The 2-year note is trading at 2.3%. So there's a way to go. The Fed's going to cut another half point at the meeting. They're going to go down to 3 because they're just way behind the curve, and that's why the markets have been getting hit.
Fed funds futures pits are saying quarter point.
Yeah, they're wrong. Look, the bottom line is the Fed's so way behind. The reason why the market's getting kicked in the teeth is because the market recognizes that the Fed can go to 2.5 and still be okay at this point in time. I'm actually hoping it. As far as today, you know, there's too much talk about today. That's the trees. The forest has been this whole big giant top that's been put in place in the market, and I don't think that's ending soon. I think we could rally some from here, but after that, I think we're going to head lower again.
All right. Well, another one of our contributors who saw a lot of this happening before did, Peter Schiff, joining us now. No surprise to you, Peter. How much further down do you think it's going to go?
Well, you know, if the Fed hadn't been as irresponsible and cut rates today, the Dow would probably be down 1,000 points today. But that doesn't mean that the Fed should cut rates. I mean, the problem is rates are too low as they are. You know, we don't need another Alan Greenspan at the Fed. We need another Paul Volcker. We need somebody to actually do the right thing and raise interest rates and stop inflating and let the chips fall where they may. Let the market go down. Yes?
Do you think the Fed should raise rates today?
Yeah, they should have raised. Well, we shouldn't even be in this predicament. They should have raised them a long time ago. But better late than never. They're going to have to raise them eventually anyway. And the longer they keep them low, the higher they're ultimately going to go, and the longer they're going to stay there. We got to get our house back in order. We need more savings, not more borrowing. We need to start producing again.
Let me jump in here with Liz. Liz, is the Fed covering up? In like a cat box, just trying to cover up something that we really should just get the heck out and
that is the debate. When you saw that, what's interesting though, when you saw the Fed cut back in December, right, a quarter point, what did the markets do? It plunged 300 points because the traders felt that they were betrayed. You know, but really, is this having an effect? You watch what happened since August when the Fed started cutting. You know, the credit markets didn't move. What you see now, though, is the auction facilities over in Europe really making an impact on a very important number, and that's the LIBOR. LIBOR is now down around
the London
interbank offering rate, and that's now 3.89. $385 billion in adjusted rate mortgage resetting next year tied to LIBOR. That'll help a lot of consumers with their mortgage payments going forward. So, you know, the real issue is unlocking the credit markets so banks lend again. And you still see the junk bond yields very high. You still see those rates very high about which banks are lending to each other. So, you know, will it help? It has a great psychological impact. I'm not that optimistic about it.
Victoria, are we expecting too much from the Federal Reserve right now. It has two responsibilities: maintain the price of the currency and stimulate growth. Perhaps we should just focus on the first and not the second.
Well, certainly we're not focusing on the first at all right now. The Fed is in a bit of a catch-22 because the consumer is weak, but so is the credit market. So what they're betting is let's lower interest rates. That's going to inject liquidity into the market. And the dollar is going to fall. But let's hope that that liquidity is going to have a greater positive than the negative of a weaker dollar. Because for the consumer, a weaker dollar isn't good news. That means our oil is going to be more expensive.
Why are lower rates, though, going to encourage somebody to lend when they get a lower return? And why would somebody want to lend money to Americans anyway? And when we've already borrowed so much money, we can't pay that back. Why would you want to lend us more, especially at low rates of interest?
Business lending.
Well, I mean, but they're trying to get money to the consumer. Businesses. Right, but businesses can borrow money for legitimate purposes. It's American consumers that can't get more loans. That's what the government is worried about. They're worried that Americans are going to stop spending. So they're trying to get more credit to the consumer to keep buying, but that can't happen. They're tapped out, and no one's going to lend money.
You want to fix this? I can fix this real quick. The SEC could step in tonight, and say, you know what, we're going to reinstitute the uptick rule, which means you can't short a stock on a downtick. You have to wait for an uptick to short the stock. Number two, wait, time out. Listen, the ECB can join in, or the Bank of Europe, either one of them can join in and say, you know what, we're going to lower our rates as well, because we see that this could be a global phenomenon. If they lower the rates, all of a sudden you have a little bit more of an equal playing field, and then you see some
guys, we got to wait till round two. We are facing a hard break, Peter. We're not doing this on purpose. We're going to hear a lot more from you and our other guests in just a moment. Well, the emergency. Well, oil is back below $90 a barrel, partly because of all that wild trading.
But gold is really up. It's higher by about $9.10, but perhaps not by as much as some people might expect after a market sell-off and a big rate cut. Back now to discuss all of it is our Fox panel, and I've got to go right to Peter Schiff, who's a big gold bull here. Gold is reacting certainly by moving higher, Peter, but is it the jump that you would have expected at this point?
Well, you know, gold had a big run. Gold is up today. It's very strong against the Dow Jones. You know, the Dow is now at 13.5 ounces of gold. This is a new low for the Dow priced in gold, which, of course, is the best way to value it. And, you know, what the Fed did today with this rate cut is very bullish for gold and oil because, you know, by making the dollar less valuable, by reducing the value of our money, prices of commodities have to rise to compensate for that loss of value. So, you know, people should be buying this dip in oil, buying this little bit of a dip in gold from the highs, and we're going to make new highs in both.
You agree, Eric?
Well, gold is very interesting. Gold is shrugging off everything. Usually gold kind of goes with oil. They kind of run together. They're a commodity basket. There's a lot of commodity hedge funds that run them exactly the same. So what gold is doing is it's putting in another buying up. It's actually trading higher, with oil trading as much as $4 lower this morning. Now, why is that? He's right. The dollar gets weaker. Typically, commodities go up. Oil's going down because if global growth slows down, the perception is that demand for oil will continue to shrink a little bit and put downward pressure on prices. Gold is shrugging off everything. Gold is going up in light of all the economic news, in light of all the slowdown. Gold is a buy. I completely agree on the gold. I'm not so sure oil's a buy here. I think it's got a little bit of room to the downside, maybe a $75 or $80 barrel first.
You know, here's the thing. I think on the global slowdown, I don't think you're going to see a real global slowdown. You're going to see a collapse in the U.S. You're going to see a big recession here. But the world still thinks that they're going to catch our cold. That's not going to happen. In fact, what's going to happen is consumption that used to take place in America is going to take place in other countries, principally in Asia. So instead of manufacturing goods and shipping them here, they're going to manufacture goods and keep them for themselves. So all the production is going to continue. All that's going to change is who enjoys the consumer goods that get produced.
Liz,
it's going to be the rest of the world and not Americans.
There was a time when gold wasn't doing that well, Liz.
Right, back in the 70s, gold was trading around $35 an ounce, and when the dollar got ripped off its gold moorings, that's when you saw, you know, gold really start to spike higher. Gold, yeah, it's going to continue to go higher. higher, I think, because of worldwide demand in places like India and China, where you have new income classes, burgeoning middle class, wanting more jewelry, and it's asset inflation. Asset inflation, and many dollars, too much currency chasing too few assets. Goldman Sachs, interesting study, came out and said that, look, you got to look at the countries overseas and emerging markets gunning the printing presses on money supply up about 21%.
What do you think we're doing?
Hang on a second. In China and India, and and in Russia, because those central bankers are more prone to political pressures, because of the powers that be who want to hold a tight, crab-like grip on power, get more sway over central bankers. That's the issue here in the United States. So, it is a concern about inflation.
Gary Kaltbaum, how does all of this talk affect the guy in the street? He's got dollars in his pocket. He doesn't have gold. He doesn't have euros. How does that affect his ability to buy things?
Well, prices for everything are going up. Everything they buy, they're paying more money for. Look, everybody is correct here. There's an absolute direct correlation between the bottom dropping out on our dollar and commodities continue to go up because oil is based in dollars, and people want return. When they see the dollars down, oil prices go up. And I got to tell you, I don't see this stopping at this point in time. The Fed continues to rain money into the economy, and as long as they continue to do that, you're going to see gold higher, oil higher, and the rest.
He makes an interesting point. We are on new ground right now. Prior recessions were triggered by oil supply problems. We are in a demand scenario for oil. Oil is very hard to find now. You had to drill in offshore in deep water. Kazakhstan, places like that, are wringing more royalty payments and getting their cut out of oil companies. So oil, the thing is, OPEC last fall, the debate was, why doesn't OPEC, up supply to wring that speculation out of the market and bring oil prices down? Speculation in oil.
Peter, let's let Victoria Barrett get in on this conversation. Victoria.
Half of the price of oil right now is really a currency issue, not a demand or supply issue. That's where the problem is. So if you are worried about your prices at the pump going up, and you're worried about everything, the cost of everything going up, with the dollar falling, investing in gold, investing in oil,
do you know how much
is a good way to play this.
Do you know how much the dollar has slid in the last 18 months? About 12%. Oil is up 100% since January 16th of last year.
And the reason for that,
the dollar. Stop blaming the dollar.
The price of oil in gold has not changed. Excuse me. The price of oil in gold has not changed. It has remained the same.
Everything is not traded in gold. They're traded in dollars.
No, Gold is money. Central bankers are debasing their money. They're creating inflation. That's where all the demand is coming from. Countries around the world are printing money. Money is losing value. Gold is real money. Gold is not losing value.
I'm not disagreeing with your demand picture for gold, but one of the biggest things that no one talks about is the investment demand for gold. People are using gold as an investment device, and that's where the buying pressure is coming from.
Gold is money.
And I want to go back
to... Gold is money.
Peter,
Gary,
hold on.
go ahead.
I just want to go back to an important point. I've been using the word credibility very often the last few weeks. You had a Fed, Ben Bernanke, on the Hill last week saying he's not worried about inflation. He thinks it's going to moderate. Obviously, he is not going shopping at stores. He's not putting gas in his tank, and he's not looking at the price of gold. And if there's any wonder that the markets are reacting poorly, it's to that type of talk.
Hey, but check this out. You got to watch out with inflation happening in places like Saudi Arabia, where they are saying depeg the currencies
and that's
from the dollar.
got to be the last word. Gang, we'll see you in a minute. Washington.
Time now to get some overall perspective about all of this. Find out where we might be headed in the final hour of trading.
For that, we welcome back our Fox panel with us. Eric, I saw you nodding when I mentioned European markets. Do traders look to Europe now for guidance?
No, but I want to touch on something Tracy said. She was talking to some traders on the floor, and they said they wished that had come out. The rate cut, what came out at 8:20 a.m. Eastern Time this morning, they had wished they had come out during trading hours. I totally disagree with them. I think, David, you hit it on the head. Europe was down until that rate cut was announced. Then they started to rally, and that really kind of put a floor in here. Europe couldn't have rallied this strongly without that rate cut, and we couldn't have helped. Look, we're down 80 now. We were at 1.600 Dow points lower this morning. It came at the right time. Boy, at the end of the day, if we end up around here, what a great move by the Fed. I was watching Paulson speak. Thank God the Fed moved when they did.
Peter, I know you don't feel that we need any kind of rate cut, but you had to anticipate it. So how did you play it with your clients' money? What do you do?
Well, I basically was talking to clients last night from my bedroom on the phone. I placed several orders in Australia, New Zealand. I bought a lot of stocks on the anticipation of a rate cut this morning. That's what I thought was going to happen. But it's not that we're going to have a recession. I'm not saying we don't need a rate cut because the economy isn't weak. The economy is much weaker than Bernanke is letting on. We just need to have higher interest rates and take our medicine. You know what Bernanke did today? He gave the market a stay of execution. Briefly, but it's not a full pardon. You know, I talked about the head and shoulders top back in December forming in the Dow. The pattern is now completed, and the projection is Dow 11,000 on that pattern alone. That's 1,000 points lower than we are right now, and we're going there.
Well, Victoria, is it that we need a recession and we need to squeeze inflation out of the economy, or perhaps it's that the Europeans need to cut their rates and thereby lifting the dollar a little bit?
Yeah, they've held their rates pretty high, certainly compared to the U.S. We never need a recession. Recession is not a good thing under any circumstance. What worries me now is, you know, this morning it looked like the markets were going to take a really ugly hit. And today was okay. And surprisingly, financials and home builders look like they were up. We don't know this yet, but looks like they were up for the day. And what I'm worried about is psychologically, do investors need an ugly day? Do valuations need to come down so that we can then get back into the market? A lot of us want to feel like we're calling the bottom, and that's never easy. No one can really do it.
But you know, unfortunately, the only cure for our disease is recession.
Gary Kaltbaum?
Look, I just want to point out that yesterday at the end of the show I talked about how down legs of a bear market end with 400 where we're down in the morning and we finish near flat on the day. It washes out all the panicky sellers, and then you get a move to the upside. Depending on how we finish today, we may get that today.
We're down just 67 right now. We're down just 67.
Right, I do think we ultimately go lower, but a day like today can end this leg of the bear, and we'll rally up maybe to 12.4, 12.5, and then we'll take a look from there.
You know, Eric, it may be that those folks who had counted on a recession in the past week are wrong. It could be, in fact, that the old scenario that Bernanke said of a serious slowdown but no recession is right.
It certainly feels like we had been in a recession the last few months, especially if you've owned a home and if you've owned stock. So, okay, so these things have a tendency to work themselves out. The selling, the pressure, all that selling, it's a momentum play. Money is clearly coming out of all investment vehicles right now. What's it going to take for it to turn around? An absolute capitulation, which is what we had. We had a European capitulation. We capitulated this morning. If we end up around here, especially if we get anywhere near unchanged, and then Apple tonight comes out with blockbuster earnings, which I think they're going to, boy, I tell you, everyone who is short into this,
David,
if you were in any Apple store, Apple store, anytime over the last 2 months, you have to wait in line for 15 minutes just to pay. This stock is
don't pay any attention to what Bernanke says. Look what he does. He's cutting rates by 75 basis points. He knows we're already in recession, or he wouldn't be doing that.
Gary Kaltbaum?
My biggest issue is that's a lot of short-term talk, which will get a lot of people in trouble. In my study of bear markets, they don't just end like this.
Peter,
they end legs like this, and bear markets die as
slow
death.
Stocks are cheap, Gary. Stocks are cheap.
Ben Bernanke, Peter, is he lying? I mean, he said a week ago we're not in a recession. Are he and Hank Paulson, do they know something we don't? I've asked this time and time again that they're just not...
They don't know anything we know, They know what we know. We're in a recession. They know it as well as I do. If you just look at the signs, this economy is a mess.
But they said they're not forecasting one.
Hold on. Paulson came out and said the fundamentals of our economy are sound. Look at the fundamentals. You've got millions of Americans with mortgages they can't afford that are about to reset higher. Home prices are collapsing. Inflation is running out of control. People are losing their jobs. We have no savings.
I get
we
that,
owe
but
the world
is the
trillions.
government lying? Are they lying?
This is the worst. Yes, this is the worst economy I've ever experienced.
And a fully employed economy, and a fully employed economy with corporate earnings that are solid and cash in corporate coffers. It's not that bad.
Our biggest financial institutions are teetering on bankruptcy. They're going hat in hand to countries around the world just to keep themselves solvent. This is a disaster in the making.
Victoria, before we all put a bullet in our brain listening to the pessimism of Peter, we have to keep a couple of things in mind. One, we are a computerized economy now that is very different. We have so much more productivity than we used to. Also, now we have just-in-time inventory. Recessions used to be caused by these huge buildup of inventory that just sat around for months and months without being sold. Now we have just-in-time inventory. inventory, so there's a lot less than there used to be.
And our exports are thriving. That's the upside of a weak
record
dollar.
trade deficit.
But
We got a
that doesn't, I don't think that
trade
matters,
deficit.
Peter. Look,
yeah, of course it matters.
The Fed isn't saying we're in a recession at this point.
Because he doesn't want to admit
read the
it.
tea leaves just like we are. But they're also leaving the door open to future rate cuts, which shows that they're concerned about where the economy is
All right.
going.
Well, I would, for the record, by the way, I would just like to assume that Ben Bernanke is not barefaced lying in front of the camera when he says
Well,
he may
you'll
be
lose
wrong,
money if
Peter, he
that's
may be
your
right,
assumption.
but I don't think he's a liar. Well, we saw a different Ben.
We are in the final 6 minutes of what has been a very eventful day for the markets.
Indeed it has. For the world economy, let's bring our Fox panel back in to talk about everything that's happened. Well, maybe not everything that's happened, but what we might expect for tomorrow. Let me go first to Peter Schiff. Now, Peter, I know you're a contrarian, but you turned out to be a contrarian who is absolutely right about the direction in which this market is going. Where do you think it goes from here?
Well, I think it still moves lower. Remember, the Dow is only down 100 points today, but that's because we got 75 basis points of rate cuts. I mean, imagine where we'd be if we didn't get that cut. And what's going to happen the next time the Dow opens down 500 points and the Fed's not there with a rate cut? This is a bear market. People have to keep that in mind. But it's not just a bear market in stocks. It's a bear market in all U.S. dollar-denominated assets. So it's not enough to sell your stocks. If you want to protect yourself, you got to sell your dollars, too. And you got to diversify abroad. And you got to buy gold.
Gary Kaltbaum, does the Fed have a few more even mini arrows in its quiver? I mean, Peter acts like there's nothing more it can do, but there are a few more rate cuts. I don't know if that's really the answer, but what do you think?
Well, look, I'm a big believer in what the markets say, and you have the 2-year note down to 2.3%. The Fed can go down to 3%. I think they're going to do that next week. But I think the problem is, and something I've said for a few weeks, I just think they're very late in the game. They keep talking about incoming data. By the time the data comes in, things are already bad. And I just think they're 6 months behind the curve. They should have been doing things a long, long time ago, and I'm afraid the markets have finally recognized that.
By the way, are they behind the curve, Eric Bowling, or is it, as Peter suggests, that they're coming out with lies, saying that we're not going into a recession when they have figures to indicate that we're already in one?
No, they're behind the curve. They should have done this a long time ago. They should have moved 50 basis points probably a month ago, and maybe another 50 now, and another 25 at the end of the month.
Why do you think they didn't?
Well, I mean, Bernanke has always said he's the studier. He's the one who studied the Depression. He is just a slow-moving Fed chairman. I'm not sure if it's going to be right or wrong in the long run, but I will tell you he's thought about it a lot. He's studied the data. This is the way he works. I think it's way too slow. I think he should have been more aggressive. He should have cut. He's done the right thing by opening the discount window. He's made the discount window wide open. We'll take anything as collateral. We'll do things like we'll auction cash.
This is a place where banks go if they don't have enough cash
so
he
does
pay
this.
out
he has
what they
other
owe.
things. You know what he can do? He can lean on the ECB and he can lean on the Bank of England to lower rates, and that would go a long way.
Victoria Barrett, if I've got my portfolio and my 401k, what do I do? Do I sit tight? Do I relax? Do I buy?
Well,
do I sell?
I think the key is to not panic. There's an instinct. A day like today, if you'd made your decision this morning, you would have hit the sell button, right? And that may have not been the best decision. If it's smart to continue putting money in your 401k. If you want to pull out a little bit of the stock market, get your portfolio to 30% cash, that could make sense. Now is a good time to be sitting on cash, but now is not the time to sell across the board. The market is still fairly valued, I would argue, if you look at price to earnings ratios. And there are a lot of markets where valuations have come down a lot, but earnings projections are still pretty high, like the software industry, which I look at a lot out here.
Well, Tracy Burns, who is down still on the stock market floor, I remember last week you suggesting that a lot of traders were getting out for good. They weren't just taking their profits. They were going to cash and with the intention of keeping the cash on the sideline for quite a while.
They certainly were, and a few that I talked to today still said that they're not getting back in yet. And of course, they come from a different perspective. They got to make money on the day. And to Victoria's point, you know, the S&P overall is still, the PE of the S&P 500 is still really cheap. So the market is actually on sale, and if you're in it for the long term, it's a great time to start buying. But for those guys, the people who have to, you know, the money they make today depends on whether or not they have a steak or peanut butter and jelly for dinner. They're not ready to get back in here because there is so much uncertainty. You know, we were saying this market's like a basketball game. Last 10 minutes are the most important part of the day, right? Well, it's like my poor son's basketball team. These kids always lose by like 30 points. The other day they lost by 15. You'd think he won the Olympics. He was so happy. And I think that's how we have to feel about this market today. We could have been down 250. Heck, we could have stayed down the 465 all day. And so there's something to be said about that. There's a little bit of some stability there, but not enough to get these traders back in.
Peter Schiff, as we're down about 126 points in just a minute or two to go, your final thought on the trade today that would be making the most sense for the long term?
Well, you know, I think people who probably sold the open, maybe that would have been a panic, but I think it's a rational decision to sell the rallies. The market is going lower. You know, despite the rate cuts, we're still down. That's a big thing. Most people would have probably thought, geez, 75 basis point rate cut, the Dow would be up 500 points. Instead, it's still down despite that.
Eric,
we're going a lot
you
lower.
would have expected that this would, at least, I'm sure, Bernanke hoped that this would juice the markets and get them excited.
No, don't forget, we didn't start this. This started in Asia and Europe while we were closed yesterday. I mean, we really stemmed a major loss. We were sitting at 5% lower. Forget it. Hong Kong was 8.5% lower this morning. We stemmed a nice loss. This looks pretty darn good.
By the way, does this market deserve a round of applause right now, Eric? Eric is applauding this market right now after everything that they've been through. There are a lot of brave people who could have made this market go a lot further south than it did.
And the last time we saw this type of number here at 11,970 was November 3rd of 2006.
Wow, long time ago.
But from rout to a bit of a recovery, the Dow down 122 points came way off the lows of more than 460 points, David.
Yeah, well, the trading day has come to a close, but our business day continues, and here's the